Our next speaker is Mikhail from Aviva. So he will talk about modeling financial uncertainty for regulated insurance companies, the case of equity risk. Thank you.
Good afternoon, everyone. It's my first time here, so apologies if I don't follow the approaches you're taking here. I was asked to give a presentation about how we model uncertainty in Aviva, especially financial risks, and I'm going to talk about the general framework and particular case of equity risk and the challenges we face in applying some methodologies. The first slide is the introductory slide. So generally, Aviva is the multinational life general and health insurance business. It's the largest in the UK with 32 million customers worldwide. It is regulated by the Prudential Regulation Authority and operates under the Solvency II regime. It's a complex business, and the previous speaker was talking about insurance companies and specific insurance risks like catastrophe. But Aviva manages about 500 billion assets under management. So for majority of the big insurance businesses, insurance risk is possibly the second or the third. So effectively, the largest risk for insurance company is the market and credit risks. So you can think about that as the shadow banking system, but it is the fact. So Aviva has a big presence in asset management. What is Solvency II? It's just a brief introduction. So it's European-wide set of rules. It's a regulation which defines how companies are governed and funded. Its main objective to protect all of us, policyholders, we're all paying insurance. The important bit defines the minimum and the solvency capital requirements. So it's the capital which is designed to absorb significant losses as 1 in 200 year event or 99.5th percentile over 1 year. So it's sufficient to cover insurance companies' liabilities for a huge crash in the market, for example. It gives you a choice of methods how to calculate these requirements. For small insurance companies, the standard formula is developed by EIOPA, which is the European regulator. But multinationals like Aviva apply for internal model or hybrid. So internal model essentially is a risk management system. And that risk management system analyzes the risk position of the company and what is important, quantify the risks. What you can see here on a graph here, so I'll try to, oh, that's wrong one. Pointer. So that's from EN16 report to shareholders, and this is one of the most important ratios Aviva reports to the market. So that's how much money we have, that's the shareholder funds, and that's the much money how we need to hold. And our job, my job, and the job of the department I work for, required capital assumption and methodology team, is to actually calculate that amount. So you can see Aviva is reasonably well capitalized, so required capital is 12 billion, so the capital which we already have is 24 billion, so the shareholder, the SCR ratio is about 190%. Having said that, other companies, the peers, have even higher ratios, more than 200%. So that's why insurance companies, big insurance companies, are well capitalized to withstand big market crashes, and I think in 2008, the only possibly AIG company went into trouble. The only big insurance company. What is the internal model? This is another brief overview. So, and this, sorry, in this graph, in the table below, you can see the key elements. So we're talking about the risk horizon. It's 1 year, so we need to model risk from on balance sheet from time 0 to time 1 in 1 year time. We have balance sheet valuation, which is economic. So it's a market consistent valuation. So the actual asset on the balance sheet should be valued as market prices. The calibration methodology is prescribed by the regulator, is a value at risk methodology, which defines the economic capital. It includes all the risk Aviva is exposed, so the market, the credit risk, the specific insurance risk, operational risks. How do we quantify those risks? It's through the Monte Carlo simulation. So Aviva runs about 1 million scenarios to quantify its losses. And how we model dependency? We model dependency for the Gaussian copula, but there are also various variations which are applied or modified the Gaussian copula, I would say. On the top, you will see just a basic illustration of how internal model works. We've got a number of risks, let's say hundreds of risks and risk factors. Each of these risk factors has a distribution behind it. We simulate about 1 million risk scenarios for all of the risk factors, and these factors are correlated. So I can tell you the correlation matrix behind it has about 2000 by 2000. It's a huge exercise. The complication comes from the legal structure of Aviva, because each legal entity reports its own profit and loss, should have its own capital, and that's why it's a complex business. We have balance sheet valuation, so for each scenario, assets, liabilities, and effectively we have distribution of balance sheet outcomes. We've got losses and gains, and taking 99.5 percentiles give you the SCR number, which we report to the market. So since my job actually is to work on the risk, on specific market and credit risk factors distribution, and here I list a number of challenges, and I've chosen equity risk because it's the most straightforward. Yeah, it's a simple risk. Prices go up, you gain. Prices go down, you lose. There's nothing specific about here. But the complication comes from the way the regulator described how we should model it. First of all, we need to model annual returns, 1 year VaR. We don't have a luxury of big data here at all. Yeah. So if you look at the historical benchmark returns, 20, 30, maybe 40 years, I think the largest we managed to find is 100 years for UK share price index. We have these issues. So how to overcome this? Traditionally, people use overlapping data. So that means you start January to December, you calculate your returns, then February to January, and so on. Yeah, so you get lots of data, but there would be lots of issues here because window choice. So is it January to December, or is it half of January to half of December? Yeah, it will change your results because of the, and it requires subjective expert judgment. The other problem, because you're always moving, let's say if you take monthly, you always move 1 month. Yeah, so you would high degree of autocorrelation in your data. That violates lots of assumptions like fitting assumption, goodness of fit. There's also lots of issues. We've been criticized heavily by the PRA and by external validation teams for taking that approach. Yeah. The other issue is more kind of business related. So if you look at the typical UK fund and European funds, so you can see, and these are long-term funds. These funds run for many years. Yeah, for policyholders' money or shareholders' money. Generally, fund managers tend to track some big indices, like UK fund may track half of this is FTSE All Shares Index, and some of this European exposure, some American. European typically fund tracks more of European exposure. But if we use, for example, overlapping data and create a hypothetical index, given that exposures, we can calibrate, even using annual overlapping data. But fund managers change the composition depending on their own preferences. How do we estimate the capital impact if a new index is introduced here? How do we, if Euro stock changes by, let's say, 30%, what's the capital? So we need something dynamic, which previously we were not able to do. And this is one of the business requirements to assist the decision. Or if we move to Latin America, some of our capital, or emerging markets, how does it affect the capital? How much the capital we should add or deduct because of the correlations, etc. And two other requirements. So we would, or issues, we would need to capture some of the financial returns facts, like fat tail, volatility clustering, leverage effects, and also we would like to be able to model the dependency structure. So when I joined Aviva about 4 years ago, what we did a simple distribution fitting. All these issues were not resolved. So we worked over the next few years for the internal model application process, and we developed something a little bit more innovative. And this is how we model risks now, and how we overcome data problems and other issues. Yeah. So first of all, we switched to monthly data completely. So we use high frequency data, which is non-overlapping, which fits our purpose, and we do all the modeling on the monthly data. So for various market risks and credit risks, we apply a variety of techniques. It could be data dimensionality reduction technique, like similar to PCA or nonlinear PCA. It could be time series techniques, various time series models to model monthly time series. You can still use statistical distribution fitting as an approach to fit a parametric distribution, and run the dependency modeling through the copular approach. So all this calibration methodology is done on the specific and monthly data. And we use the outcome of the monthly data, the models which we built, into stochastic simulations. And we generate a large number of scenarios for equity risk, 6 million monthly scenarios. So we simulate that. And then we use a kind of, it's called temporal aggregation technique, but effectively it's summing up through your simulations. What it does, it helps us to obtain annual non-parametric distributions which are based on non-overlapping data. And this is the key, yeah? And since the today topic is about uncertainty, because everything you see here is all about models, various models, and how we simulate. How do we check if the models are adequate, yeah? And we're lucky in that sense in comparison to other fields because we are regulated. So when you're regulated, so you can do the benchmarking exercise. So all big insurance companies, they subscribe Tower Wilson survey for the biggest risks. They supply their numbers, the stress levels at 1 and 200 levels. So we can always benchmark ourselves, yeah, against the competitors, or peers in that sense, yeah. So we're lucky, so we can see, so we're not underestimating the risk because maybe there is model risk. So as long as we feel the coverage is adequate for any of the particular risk, so we're relatively happy about that. Finally, all the models, all the documentation, everything goes to the Bank of England. So they check every document, they check our approach, they check the methodology, and then benchmark us against their own models. So it's another way of benchmarking is through regulator, and working in the required capital methodology team is the most important thing. So if your regulator approves or not, yeah. So if you have an adequate coverage for the particular risk, if you don't, so they will normally issue add-on to the capital saying, so your model is weak, yeah, your stresses are weak, so that's why you need to add to your capital an X amount, is what it happens. So we also have the final annual parametric and non-parametric distributions go to the internal model, and then each of these distributions is further simulated 1 million times, yeah. And then on the top of that there are ALM models which show you actual balance sheet movements. So effectively it's a complex simulation exercise to come to this solvency capital requirement numbers. Okay, so now I'm going to talk a little bit more technical, but since I wasn't sure about what should I present, but I'm going to talk about some techniques we're using on the way how model the equity risk. For example, if we have monthly data, so we apply a well-known range of GARCH models. Here, GARCH models are specifically designed, and the discrete models, it's a volatility models. They're specifically designed for equity returns. They capture, or most of them tend to capture that observed facts like fat tails, asymmetry of returns, and some other leverage effects. Yeah. So we use generalized GARCH models, and I've just produced a formula, and so we model actually autoregressive variance here. So asymmetric models tend to add an extra parameter to the models just to shift the distribution slightly. However, what we found, which is interesting in monthly returns at least, that asymmetric models do not capture that left skewness of the equity returns quite well. And we're very much interested, from the risk position, we're much interested to capture that. That's why, try again. That's why here, so that's a general model, so model H here. But this guy here, epsilon, so we also, which is residual, so we also try to fit a range of distributions, starting with normal student T and skew student T. And quite amazingly, the majority of model for our indices, we capture about 30 of them in this modeling exercise, show that the skew student t distribution is the best one. So even the models, asymmetric models, are designed to capture that behavior, so we still need help some of the, with the residual modeling. Altogether, we run about 30 different types of models per each index. So that ensures, so we try to capture all the, so we take the index, its behavior, historical behavior, and run all these models, pick up the best one based on information criteria, and try to find the best solution to that particular index or the best modeling approach. And it's, again, it's a kind of remove some model uncertainty, I would say, or maybe introduces overfitting, so it's another way to look at that. But that's the approach we've taken here. So since we model the monthly time series, we've got the time series model, we've got the deterministic part, we have stochastic part. So then we need to model dependency structure between the residuals. And here there is actually, there is only one choice possibly. It's the Coppola approach with the Monte Carlo simulation. And then the approach why we've chosen is because it's flexibility. For example, if you, during the year, if you have 2 more indices, let's say, and the business wants to investigate the capital impact of those indices, you don't need to rerun everything, yeah? So you fitted your Coppola once, you just use the same Coppola, but add these 2 indices in the correlation matrix, and you can rerun that. So it's a flexibility of the approach, which separates the marginal modeling and the actual Coppola modeling. And this is the one of the key advantages of this methodology. The final part is a temporal aggregation. There is a field in time series analysis, which is called temporal aggregation. And a general assumption is very simple. So all the economic or financial time series are indexed by time. So the choice of frequency clearly influences the estimation results. So it is logical to assume that estimated models for different frequencies should also be related. The theory is quite well developed for the normal case and for some linear models. So the annual data can be considered as a function of the monthly data due to the aggregation process, yeah, because we sum up 12 observations to get the annual results. So the annual model is also should be a function of the monthly model. And the theory actually develops that approach and proves that there is a closed form solution, an analytical solution to that aggregation issue. So I don't describe the model because it's quite complicated and quite involved, but you can see in general, so the aggregated variable is a simple aggregation scheme, so it's L is the lux here, but the aggregated series, what is important for us, do not overlap. So here is what we're trying to achieve, so we need to simulate non-overlapping data, and aggregated series do not overlap. And as an example, I just put a very simple example. So if we have disaggregated R1 model, autoregressive model of order 1, which is expressed here in mathematical terms, and assume the aggregation frequency of 12, which is from monthly to annual, the aggregated series follows ARMA1 representation. So is an autoregressive moving average model. And you define all these parameters. Everything is on this model is defined from this model. There is a quite involved approach how to do that by applying some polynomial transformation, but there is a way to do that. So I've got 2 more slides. This is just to summarize how a model thinks, yeah, and I present some results. So the first step is we take the monthly univariate time series and we look at the statistical properties of this data. What type of model we can use effectively? So that's a big research question here. So we run dependency tests, we run stationarity test, all of the bunch of tests which would give us insight what the data looks like. Then we model univariate marginal equity returns by using the appropriate time series techniques, and we'll run about 30 models for each of the index. So we take the residuals from that step and apply use the Coppola. We model the fit the Coppola, and then given the dependency structure of monthly returns, we simulate 6 million returns. Yeah, let's say 6 million uniforms, and then we get them back into the corresponding monthly model. And the final stage, we apply temporal aggregation technique, which I just talked about. Actually, it's just a summation to non-overlapping annual returns. And all the steps, you just need to do once, yeah? But then, at the final steps, you apply your portfolio composition. And that's the beauty, because you can calculate the dynamic SCI. You can change the portfolio composition anytime you want. So you don't need to go through all the steps. The steps are already done. But you can apply different portfolio weights to your calibrated indices or simulated indices, and you get straight away, in a second, you get a new distribution. You can input it into internal model and get the capital impact. Here is what the typical equity stresses would look like for the big portfolios. And they're all in the region of 45%. So that means with the probability of 99.5%, you can lose half of your equity in 1 year. And this is so that shows you it's a very risky asset class to invest, unless you hedge it. And that's just a distribution of these returns. So it is 100 and 100. And so the conclusion. So I just showed you our way of thinking, how we calibrate those risks, and how we develop the framework which allows to overcome some of the challenges we face, either through the feedback from the regulator or the business requirements. So we showed that the main advantage is the flexibility. So we model marginal contributions, marginal distribution and dependency structures separately. We utilize a number of well-known theoretical approaches. There is nothing groundbreaking here. Yeah. So we just taking the existing, well-developed parts, yeah, in the financial models, in the copula theory, in time series analysis, and combine them together to give us what we want. The advantage is there is a closed form solution for a number of model specifications in temporal aggregation. Unfortunately, because all follow normal distributions, we're quite not able to use them, but there is a possibility of that. The framework has been extended from equity to all other risks in Aviva. Effectively, all credit, all the market risks, not sure about insurance, but are modeled in that way with various modifications. And finally, the major advantage, it has been approved by the PRA. So it's a part of the internal model. It's a part of how we do things. And it's what we're paid for, yeah. And however, I listed just a number of limitations. There are many here. It's a model-dependent approach. It's all about different models. If you have models, you introduce model risks. But as I mentioned, so model risk for us is less important because we benchmark ourselves. And as long as we have adequate coverage for the particular risk, so we're okay. Yeah. So normality assumptions, again, for closed form solutions, and that doesn't, I would like to have analytical, but takes time, possibly impossible to get. And always, this is always expert judgment overlay is required here. And it concerns the models, the copulas, everything. In fact, we have a governance process, and we have to sit through various committees or expert judgment panels to get an agreement between various stakeholders on a particular, even model parameters, even the level of stress, etc. So, but that's the part of the work. Thank you very much.
Okay, thank you very much. Are there any questions? So, in fact, both talked about sort of the 1 in 200 risk in a single year, but what if you get 2 or 3 extreme years in a row? Do you protect against the compound risk across?
That's a good question. It's another limitation, because the limitation of the internal model, so it's only 1 year view. So if you have particular risk, let's say property, yeah, it's a very good example. So historically, if you look at the property market, commercial property market, there were 3 big stresses. The property prices dropped 30%, but then within the next few years they would recover. Yeah. So effectively, you would need to have a view. So if, let's say, if your model predicts -30, should it predict the next year -30 as well? Yeah. And we come to the conclusion it shouldn't. Yeah. So, but then brings you the question of the conditionality into internal model, and it's a big unknown. Yeah. So at the business units level, let's say UK Life or some people who manage those risks, not the group level, they tend to model that, yeah? So they tend to model the recovery as well. So they don't apply mindlessly -30 and a -30 and again -30, yeah? But that's a limitation of the current model on its own.
So value at risk is a standard kind of risk metric, but I mean you must have other. You must have a portfolio of different risk metrics which you look at when you do testing. Just not.
It's the only measure for required capital. Yeah, SCR is the only
It's the
measure.
only measure for the regulator, but you
Yes.
must have your own internal risk metrics.
I'm sure that because Aviva is big, I work in the part of the Aviva, yeah, so we're calculating SCR. And I'm sure, there is Aviva investors, I'm sure they have their own risk measures, yeah. But it's what is reported, it's important, that ratio, yeah, is what, it may even define your creditworthiness, yeah, at the end of the day. Yeah. Because it's what the investors are looking at. So if it's going up, it's good, yeah. If it's going down, so you're in trouble. Or you're taking too much risk. If you're taking too much risk, where is your profit should go up or down, or, so lots to consider.
Any further questions? I have one regarding your last point, expert judgment over the industry buyer. So how do you have any ideas how to incorporate expert knowledge of?
Well, normally, let's say, you'd present to the expert panel, you collect, so you all the experts from around the world who have an interest in that subject, or let's say equity, they would come around and say, you present a number of models, say, look, that's the actual level of stresses, that's the model we use, that's the outcome, that's the capital impact, yeah. And people will form their judgment, yeah. It's not obvious, it's not always we can achieve that, yeah. So effectively, especially with the interest rate risk, yeah, where does it go, negative, positive, yeah, how it affects. So it can be very complicated. And sometimes people are unhappy. Yeah, so.
Okay, so it's more like in the final stage.
No, it's not the final stage. So we initially we set up a number of expert panels. So before we start modeling, we say, okay, so here's the risk. These are our modeling approaches. Do you generally agree how we approach that particular type of modeling? They say, okay, well, investigate this, that. Yeah. So we investigate, present the results, and we say, okay, that looks reasonable. Go further. Final results. And then all the chief risk actuary, the sign off, etc. So it's a governance process, takes about 6 months. That's a highly regulated environment, so you have to document everything. Everything is recorded as well, so the PRA can listen to what you said, who said what. So.
Yeah, just a quick question on sort of the interplay between models and human behavior. There's always this assumption that there is an objective reality that's out there, and all we need to do is to capture enough information for us to calibrate parameters, and once we're there, everything is sorted. But in a lot of situations, the reality is that how we use those models and the decisions that we make also has an influence on the thing that we're trying to model. And I think within the financial, as an example, if you take interest rates and the demand for fixed, for bonds, and pension schemes desired to hedge, increases the demand for those instruments and has an impact on the rates that we observe on the market. And there are numerous examples of that nature where the results from models, especially if they're used by a large enough community, has an impact on the system that's being modeled itself.
No, I totally agree, yeah. So, and it hasn't, it could be modeled, but possibly at the PRA level, yeah, but not, we don't model at an Aviva level, that kind of behavior. So people think about that, people have an opinion, and one of the good examples, 2 years ago, Mark Carney, who is the chairman of Bank of England, was talking about interest rates going up, yeah, and everyone was in the mood. 2 years ago, they were going up. By the end of the year, they've gone down, yeah, so we underestimated the risk of them going down, but we overestimated the risk of going up. And this is a clear influence from the regulator, so they can't predict that, yeah. And there's complete uncertainty from even from the PRA, yeah. Okay, thank you.
Okay, thank you very much. I would like to